Hi everyone, my name is Speziale, and I'm the national best-selling author of Market Masters. Today, I'll be sharing with you how I pick winning stocks. In 2005, I opened my first brokerage account with CIBC Investor's Edge. I was 18 years old and just started my studies at the University of Waterloo here in Waterloo, Ontario, Canada. I invested in 5 stocks. $10,000, $2,000 in each of those stocks. I didn't really know what the heck I was doing, but I needed skin in the game to learn the ropes. Here's what happened with my portfolio within the first year. 3 stocks traded around the same range. 1 stock got bought out, and the other stock was a high flyer. I got lucky that first year. The following years had their ups and downs, winners and losers. But it wasn't until I had invested in the market for about 10 years that I truly felt confident in my stock picking abilities. Still, not every stock I pick is a winner. That's impossible. Though, what I learned was that cutting my losses and reallocating that capital into winners over time made up for these losses and then some. Today, I tend to invest in these 3 buckets. So in other words, my stock portfolio is segmented into 3 areas. First is mispriced large cap stocks. The second, speculative takeovers. And the third, small and mid cap capital compounder stocks. So the first, mispriced large cap stocks. For example, I started loading up on Starbucks stock in 2008, around $15 per share, at a time when Starbucks was oversaturating themselves in the market, with most experts doubting their strategy of selling high-priced coffee, especially with the financial crisis looming and new entrants in the coffee business, such as McDonald's. However, when I bought Starbucks stock then in 2008, after its huge decline in the market, I never witnessed a drop in traffic among the stores nearby me. Starbucks had huge competitive advantage then as it does now. I thought, if Starbucks goes out of business, that's probably when the world will end. And seriously, do you think business people would ever switch their coffee meetings from Starbucks to McDonald's? Now, to explain more this idea of investing in that first bucket, mispriced large caps, these are big companies that reside on the S&P 500, the Dow Jones, the S&P TSX 60. These are companies that have, in the short term, fallen on hard times, like Starbucks did, like Netflix did years ago, like Disney did in 2015, 2016, as well as Apple. These are big established companies that have short-term declines in the market. Let's say about from 10 to about 50% declines. 50% to that extent being the most rare. But there's always opportunities to buy in on these small dips in the market, especially in the large caps where you have more confidence in their ability to revert to the mean price. For example, Apple stock, after falling, let's say 20 to 30%, then reverting back to its mean over time as it resumes its growth, albeit not at the same rate as 5 or 10 years ago. So that's mispriced large caps. The second bucket that I invest in are speculative takeovers. So here's an example. When Lowe's first bid for Rona, which is a Canadian home builder retail store, fell through, I bought a stake in Rona and just sat on the position. I speculated that Lowe's or another company, maybe Home Depot, would eventually come back and scoop up Rona, with the Quebec government's approval, of course, as well as the shareholders of Rona. When Lowe's did come back years later, bid on Rona a second time, winning the approval to buy them out, my Rona shares that I had bought a couple of years prior shot up 100% in one day. Well worth the wait. Now, I also dabble in speculative takeovers, especially through investing in small cap stocks. So those are smaller companies that reside on the stock market. Let's say they can trade from about 25 million to roughly around $100 million market capitalization. And some of these companies might not be generating a profit just yet. Maybe they are on the cusp of generating profit, but they're usually these smaller, high growth companies that these larger companies would just love to come and scoop up, to either take out competition, to acquire software, technologies, skill sets within the company. So that's the second area, speculative takeovers. But the third bucket, the small and mid-cap capital compounders, that's my most successful bucket in my portfolio based on the returns. Why? Because I find that the intrinsic value of these businesses just grow exponentially every year. And with the growth in intrinsic value, the price of the stock just grows very nicely year over year. I like to see around a 15% annual growth in these capital compounder stocks in the small and mid-cap space. I'm actually upset when one of my capital compounder stocks gets bought out, because most of the time there's so much more potential for growth. For example, was Tim Hortons. Tim Hortons was growing very nicely, and the stock performance showed for the years I owned it in my portfolio. Tim Hortons got bought out by a company which is now called Restaurant Brands International. Restaurant Brands has Tim Hortons, Burger King, and now Popeyes under its umbrella, and it's a stock that I do also own, and they are growing internationally. So when these great companies get bought out, it forces me to go hunting for an equally remarkable capital compounder to replace those buyouts. So here are the characteristics of these capital compounder stocks. So what you want to do is that when you pull up the income statement and balance sheet and cash flow statement, you want to see a couple of things. You want to see high growth in revenue year over year, over 10 years. Now, I like to see at least 15% growth in revenue year over year. Also, a high return on equity, or a ROE of 20% or higher, and a high return on capital, so 10% ROIC or greater every year. I also like to see growth in free cash flow per share, growth in book value per share, and growth in earnings per share. The reason why I say per share is that what it comes down to is shareholder value. So what is the company creating for you, the shareholder? Is management good stewards of your capital that you invest in these stocks? So I analyze these characteristics in a company over a period of time, at least 5 years, preferably 10, as some companies can post these great records, let's say a high return on equity, ROE of 20% one year, but then fizzle out the next year. So you want to see a long-term track record of, I'll repeat that again, so growth in revenue, high growth, high return on equity, 20% or higher, high return on invested capital, 10% or higher, growth in free cash flow per share, book value per share, and earnings per share. And what it comes down to, though, is after you look at these metrics, and you can use a great website which is called morningstar.com. Morningstar, you can search any company. Now let's say you search Spin Master Toys. You can click on the key ratios or key stats for Spin Master Toys, and it pulls up a table over 10 years with all these metrics. But the numbers don't tell the entire story. You have to think on a different level whether this company, let's say Spin Master Toys, has the competitive advantage, has the durable advantage to stick it out, to be successful over the long run, because these great metrics can deteriorate quickly if new competition comes in, if you have poor management running the company, if the financials, if the books aren't controlled well, and all these different criteria must come into play, these qualitative factors as well as the quant factors that you look at through metrics. My favorite sector because of this are consumer franchise companies. And for that reason, that companies that sell products directly to consumers, established companies, again, the mid-cap space, they're not as big as an Apple, but there's a sticky business. They're selling to consumers on a weekly, monthly basis. Like, think the concept of selling toothpaste over and over and over and over again is recurring revenue for these companies. These companies have pricing power in the consumer space, whereas, let's say, an oil and gas company, they're price takers. They can only sell their goods the price in which the market is currently evaluating, let's say, the price of a barrel of oil. And these consumer companies, they have more predictable cash flow out into the future. Again, my friends who work in investment banking, their financial models that they put together are only as good as the inputs into the model. And with certain companies, such as pharma companies, it's very hard to model out the next 10 years, let's say, of revenue, earnings, and cash flow. But it tends to be, at least in my experience, at these consumer franchise companies, you can more accurately predict their cash flow into the future. So a company like Spin Master Toys, a company like Sleep Country Canada, which sells mattresses directly to consumers, these are more predictable companies in the long run, and they're both examples of mid-cap companies. So if you go to my blog, which is on robinspeziale.com/blog, and I'm going to link to it in the description, you'll find my blog post with a bigger description of how I look for these capital compounder stocks. So thanks for watching, everyone. Please subscribe to my channel for new content, and visit my blog again on robinspeziale.com, and finally, buy my book, Market Masters. All links are in the description to this video. Happy investing, everyone.